Welcome to the Multifamily Wealth Podcast. I'm your host, Axel Ragnarsson, and on this show, I dissect how seasoned multifamily investors started, built, and scaled their businesses. What's going on, everybody? Welcome back to the Multifamily Wealth Podcast. In this week's quick solo episode, I'm going to be talking about exit cap rates and how you need to think about exit cap rates and specifically underwriting exit cap rates when looking at new deals and underwriting potential acquisitions, given what's going on in the market right now. So this is basically going to be some free form conversation where I'm talking about how I think about this right now, what we're doing in our business, and I guess some tips for the listeners in terms of how they should think about underwriting exit cap rates. So put simply, a question that I get asked pretty frequently is, how are you thinking about underwriting exit caps? What are you using as an exit cap rate assumption? What are you increasing your exit cap by per year throughout the hold period? Basically just trying to, folks looking to get a sense of what should I be using as an exit cap rate in my underwriting. So I think that what's been relatively normal over the past few years is increasing your exit cap rate by 10 basis points, 15 basis points or so per year that you hold the property, right? So if you hold it over 5 years, maybe that's 50 basis points, 75 basis points, something along those lines. So if you're buying today and the market cap rate is 6, when you sell in 5 years, maybe you're using 6.5 or 6.75 or something like that. And in general, I think that that approach from a conceptual standpoint is wise, right? You should be increasing the cap rate per year of hold to try and mitigate downside risk, right? To try and conservatively underwrite the deal so that if the market does adjust during your hold period, you've prepared for that. Now, there's a lot of questions around, do we increase that margin throughout the life of the hold now, given the fact that cap rates are actively expanding in the marketplace as we speak? If so, how much do we expand it by? And I think the challenge with having a general conversation around this is it's incredibly nuanced, because obviously real estate is hyperlocal. It depends on the market you're in, depends on the product type you're buying, depends on the asset class that you're playing in. But in terms of how we're thinking about it, I think of, and I'm going to just try and start with my thoughts at a very high level and then continue to narrow them down. So very fundamentally speaking, I think there's two types of markets, right? And this is so incredibly broad from a generalization standpoint. But you have supply constrained markets and markets that are not supply constrained or just less supply constrained. And yeah, there's a shortage of housing throughout the nation. Every market is quote unquote supply constrained. Every market could use more housing, right? I think that's, again, very true. But there are differences. There are different levels to that. The Northeast, for example, New England, just New England, Maine, Vermont, New Hampshire, Massachusetts, New York. If we start going outside and head a little bit, outside of New England and head farther south, Connecticut, Virginia, right? If we really, the whole Northeast U.S. is very supply constrained because in a lot of those areas, it's not profitable to build. A lot of these areas, it's tougher to build from a legislation standpoint. You also have the ocean on the right side of you for a lot of these states. And there's a lot, it's mountainous. And again, speaking generally, but there's just less construction up there than there is in other parts of the country. Same goes for California, typically a supply constrained market. Same goes for, parts of Colorado, right? There's different areas of the country that because of the political nature of that market and the challenges in building and the disparity between building costs and what you can lease units for, they just don't make sense to build. So there's less development. Now that's different than a market like Houston, where there's no barriers to development there at all, right? There's tons of development in Houston. And again, speaking generally, this is the case throughout, markets like Arizona, New Mexico, Florida. These markets have had a lot of supply added to the marketplace. So why am I saying all that? Because you may feel like I'm getting sidetracked. Cap rate expansion is going to be different depending on what the supply and demand dynamics are in a given marketplace. Now, it's going to be different everywhere. But for example, in the Midwest, in the Northeast, cap rates did not drop as low as what they did in markets like Phoenix or Tampa or Austin or Dallas or Jacksonville or Atlanta. All of these markets that had all of this incredible growth And there's still great growth drivers, obviously, behind those markets. People are still moving there, jobs are moving there, companies are moving there, et cetera. But there was more development there to try and keep up with that demand. And the stats back this up. There was all kinds of development in the pipeline for 2021, 22, and in 2023, and also into 2024, right? So in markets where you just naturally have more of a boom and bust that have more of a boom and bust dynamic, which are a lot of the markets I just mentioned, cap rates are probably going to expand a little bit more quickly, right? I think that's a safe assumption to make because it's a little bit more of a whiplash effect. And the same thing happened in '08 with a lot of these markets where pricing goes up, right? Cap rates go down, and then they rapidly readjust when the market starts to readjust. And they probably have more of a volatile reaction to what's going on, macroeconomically speaking, from the capital market standpoint. And once you added supply, again, a little bit more of a boom and bust dynamic. So if I were in those markets, I might increase the rate at which cap rates expand throughout the life of my hold period, especially if I've been buying properties that are like C-class multifamily, where the rate at which cap rates compress for C-class multis is higher than, for example, A-class. In a lot of markets, A-class was trading at maybe 5 cap valuations for a while, and then it dropped to 4, 3.5, 3.75, something like that. And, cap rates over the last few years have dropped 100, 125, 150 basis points. Whereas in those same marketplaces, maybe 1970s built C-class properties were trading at 6.5, 7 caps, and they dropped all the way down to 4.75, 5 caps, where they dropped 200, 250 basis points. Again, different in every market, but that is something that kind of happened throughout the country in the last few years, right? By and large, that's pretty much the dynamic because capital kept chasing yields, kept chasing yields to the point to where cap rates became compressed at a more significant percentage of what they were before comparatively to A-class or new development or B-class or what have you. Which is why a lot of investors started buying A-class that previously bought B and C-class. And also there's all kinds of dynamics around that as it relates to new syndicators getting in the marketplace and having to default to buying C-class assets because that's what they could afford. And there being all kinds of competition at that level. So in those markets, yeah, maybe you want to expand your cap rates 20, 25 basis points per year. Conversely, if you're in a market like, Indianapolis or New Hampshire, like we're in, or any of these other markets that are a little bit more stable, which is kind of the Midwest in general and the Northeast to an extent. Yes, you should still be probably underwriting a higher, or more significant cap rate expansion throughout the life of your hold. If you were doing 10 before, maybe you increase it to 15, 20. But I think that personally, this is my own opinion, my own 2 cents. I think that these markets will be less affected by what's going on in the macroeconomic environment and in the capital markets environment because there's less supply being added and because these markets didn't have so much capital infused into them over the last few years and there wasn't as much buyer demand in these markets. They weren't as hot, right? So naturally, slightly less of a boom and bust dynamic. So that's just a very high level 2 cents on that topic. Other components to consider here are and what's funny is I think oftentimes what's forgotten as it relates to modeling out exit cap rates is a fundamental understanding of what the current market cap is. And I think people oftentimes grossly just misunderstand what the current market cap rate is in their target market. And I think that's something that's happening as we speak right now, where people think the current market cap rate is X, and maybe there's a deal here or there that support that as the market cap rate. Maybe somebody completes a 1031 into a stabilized deal and they pay a 5.5 cap, and and maybe that still feels low for the investors participating in that marketplace. But that's probably not as much of a reflection of the true market cap rate in that market right now than it was in times past, right? And just because one person bought a deal at a market at a low cap rate, however that's defined in your market, doesn't mean that that's still what it is in that marketplace. Now, if there's 10 offers on that deal and somebody buys it at that cap rate and the other ones are around that number, then okay, then that's maybe a little bit more indicative. But we have to be aware of the dynamics of deal making right now, and that deals that close today, oftentimes that price was agreed on 90 days ago, right? So we're always looking 90 days, 100 days plus in the rearview mirror. And when we look at closed deals in terms of the pricing that people agreed on, and I think that people think that their market cap rate right now is lower just than what it is, right? in our local market and one of the markets that we participate in, people are still underwriting deals at like a 6 cap right now in terms of that's what they think the current market cap is. And then they start building out their cap rate expansion off that number. But in my opinion, we're closer to a 6.5, 6.75 cap in that marketplace right now. Because I don't think that the current market environment has truly caught up to what buyer sentiment is at the moment. So I'm basing my cap rate expansion off of a higher market cap rate today than I think other people are, which is enabling us to be a little bit more conservative in our decision making and in our underwriting. So I think that that's another thing that people really need to make sure they understand is what is the current market cap? Because if you don't get that right, none of the other stuff matters and you're putting yourself in a bad position to start with. And the last point that I'm going to make on this topic is oftentimes people want to compare cap rates to treasuries, right? Or cap rates to what people can earn in other asset classes or in other alternative investments or in the stock market, right? And it's oftentimes challenging to do that because it's an apples to oranges comparison, right? I think it's very compelling right now to just throw your money in treasuries and earn 4.5%, 5%, depending on where they are right now at the time that this episode airs. That's very compelling. It's liquid, it's risk-free, unless the government implodes, which obviously is a low probability of happening. So why wouldn't you do that? But that's a little bit different than I think what a lot of people that invest in real estate who listen to this podcast do, which is buy value add real estate. So it's like, yeah, if you're going to go buy a 5 cap stabilized deal where there's literally no opportunity to add value, you're probably better off putting your money in treasuries. But if you're in a situation to where you can buy a deal at an in-place 3 or 4 cap because the current owner is completely mismanaging it, and you can invest some money in CapEx, but you can stabilize it, to a stabilized yield on cost of 8 or 9%. And if the market cap rate is 7.5, well, then you've created value, right? And there's still a reason to be putting your money into real estate. So what, and that doesn't necessarily answer the question of how do treasuries affect stabilized cap rates or the current market cap rate that you'd see upon a refinance, right? So that doesn't necessarily answer that piece of it, which I'm going to get to now. And while in 2022, there was a massive spread between treasuries and market cap rates, right? Maybe C-class deals were trading at 5%, but treasuries were at 0.5, right? And we had this massive spread between the two. And that spread has been rapidly closed, if not completely closed now for a lot of asset classes where you can earn 4.5%, 5%, but you can throw your money into a deal at 5, right? What is that going to do at a 5% cap, I should say? What is that going to do to the market cap rates? I mean, it's going to expand them. Like, I don't know how people don't think that. I don't know how anyone out there who's rational does not believe that market cap rates are going to continue to expand right now. It's just, they have to. The math simply does not work at the current cap rates. And that doesn't account for other things happening though, right? So yeah, maybe the spread between 10-year treasuries and the current market caps is narrowed from 400 basis points to 200 to 100 basis points, whatever it is in your market. And depending on where you are in the country, it's a different number. But I personally don't believe that there's going to be some arbitrary spread in perpetuity between treasuries and market caps, because there are all kinds of other benefits to investing in real estate. You obviously receive tax benefits. You receive, passive income. You're giving yourself an opportunity to earn outsized returns in the future, and your all-in return, even if your cash-on-cash return is lower, is still higher because you're paying down your debt. You're putting yourself in a position to take advantage of inflation over the long term. Rent growth, if it outpaces expense growth, is going to continue to grow the value of your asset. So yeah, even though that gap may narrow, I still believe personally that people are going to elect to put money into real estate because they're giving themselves other chances to make money other than just a fixed rate of return. And if done so correctly, you're still mitigating your downside risk over the long term. If you conservatively leverage, fix your rate, don't put yourself in a position where you can lose the deal type of thing. So while, yeah, there has been a historical spread between the two, I don't think that spread will stay the same exact, or will remain the same exact spread over a long period of time, I should say. And it's possible that it changes and it ebbs and flows. And I think that's normal. And, the other piece of this is the fundamentals of multifamily housing are not changing that significantly, where still have a housing shortage, still not enough product being built. The United States continues to become a renter nation. There's less people buying homes. Homes are completely and utterly unaffordable right now. I mean, it's absurd how unaffordable single family housing is to owner occupants. So, people are going to be staying renters for longer. And those fundamentals are not changing. And even if unemployment rises or wage growth starts to stagnate, yes, that will affect rents. Maybe rents decline a little bit, but I don't see a situation in which rents drastically decline in terms of 10, 15% drops, consistent year over year drops like that. Maybe they drop 10% from their peaks in 2021. And, we have like a 3-4% drop over a couple of years, and then they start to flatline and maybe grow again. But over the long term, as rents continue to grow, assuming that they continue to outpace expenses, relatively speaking, which is why it's important to be in quality markets, I think we're going to be okay, assuming that we continue to underwrite some level of expansion. So what are we doing in our business? I think I've talked, I don't even know how long for, what feels like an hour here. But what are we doing in our business? In New Hampshire, we underwrite 20 basis points a year in cap rate expansion. So if you buy today, our opinion is, depending on the submarket, if it's if we think it's a 6.75 or a 7 cap market now, we think it'll be an 8 cap market in 5 years, right? If we're in markets like we're at in Central Florida, maybe it's a little bit higher because of the nature of that market. We have all of this tailwind from a growth standpoint, but expenses are just running away from us. Insurance costs are going completely through the moon. Utility costs are high. Property taxes get reassessed more frequently. There's more supply being added to the marketplace. So I think that capital and there was a whiplash effect where I think cap rates artificially dropped below where they needed to be over the last couple of years. So I think that there's going to be more significant cap rate expansion in that market. So we're underwriting 25 basis points per year, right? So if we buy today and we believe the market cap is 6.5, we're underwriting a 7.75 exit in 5 years. It's pretty conservative. We're much more conservative than what other people in the marketplace are doing right now. But we have to be if we want to feel comfortable doing deals at the moment. So that's what we're doing. I hope that free form conversation added value to some of you folks out there. And if it did, please be sure to leave a rating and review for the podcast. Shoot me a message on Instagram. Let me know if you agree or disagree with the comments I made at Multifamily Wealth. And again, as always, thank you for listening, and I'll catch you guys next week. Thank you for listening to this episode on the Multifamily Wealth Podcast. If you learned something new during the show, please consider sharing this episode with a friend, family member, or business partner, or just leaving a rating and review as it helps the show get noticed by more folks. Catch you next week.